Viktor Shvets, Head of Research and Strategy at Samsung Securities, joins us on the program on this Tuesday morning. Good to have you back, Victor.
Thank you.
Let's first talk about these comments coming from Jürgen Stark of the ECB. He's saying that he could have the European debt crisis, we could see the European debt crisis solved, contained within 2 years.
Right. Well, it shows you, Eurocrats. They think that they have 2 years to solve the problem. They don't. And as emperor fiddles, the Rome burns. So what you have seen right now is a massive divergence between equity market and bond markets. Fixed income markets are really signaling a great deal of distress.
Yes.
But not the equity market. The question is, who is right? Both of them cannot be right.
Right. Okay. And why is there this divergence? And I guess ultimately, who is right?
I think bond market investors right now are right. Usually fixed income market usually is right rather than equity market. So as a matter of rule, that's your default position. But I do think the bond markets are correct because there is no solution to the Eurozone problem, at least not a solution they're prepared to consider right now.
Okay. Well, you know, it seems that everyone's watching closely on these bond yields on the 10-year Italian note inching closer and closer to 7%. Is that the make or break for you?
Actually, any increase of 100 bips or more, it's effectively 12 to 13 billion euros extra that Italy needs to find in terms of budget deficits. So anything approaching 7 or 8% is really a break level for Italy.
Okay. So if Italy goes, do you think it will, first of all? And if it does happen, what does that mean?
Well, what it means that this problem has no solution. The only solution to this problem is ECB printing money. The problem is neither the Germans nor anybody else is prepared to entertain it. So they're finding convoluted solutions which don't really solve anything at all. So every time we have a final solution and then we have another final solution. So the problem is the longer you wait, it's not just Italy, it's Belgium, it's France. So if you look at the spreads on Belgian bonds, they are now running at 250 bips against German bonds. It's France. So you get to the point that solutions become more and more difficult. Eventually, you will have to break up the euro.
Okay, well, you said that you don't believe that investors have yet reached levels of maximum despair, meaning that they haven't faced the reality that we could see a breakup of the euro?
Oh, you could. You could easily. The way Eurozone is doing right now, you could easily see a breakup of euro. But I would argue more likely is that the Germans will have to surrender. In a sense, somebody has to pay for everything that happened in the last 20 years. And at the end of the day, it will have to be German taxpayer through high inflation.
Okay, so considering it seems like there's doom and gloom, that's what you're predicting right now for Europe. What's going on in the equity markets? Because we're still up on the year, by the way, in Wall Street.
Yes, we are. Yes, we are. It's very interesting because I said there is a dichotomy between the two markets. It happens quite often that equity markets would look forward. Equity markets is a very much discounting mechanism. And what they're trying to do is to say what is going to happen in the next 9 months, in the next 12 to 18 months. And the perception in equity markets is that something is going to work out. It's going to be fine. I don't think it's going to be that easy. I think we're going to have rolling heart attacks in the next 3 months, 6 months. So it's not going to be that easy.
Right.
Whereas equity market discounting tail risks now at a very, very low level. The bond markets don't do that.
Okay, so we are in a bear market, right? This is a bear market rally.
We are.
It might last 3 months. Is that what you're saying?
It might last a month. It might last a week. You never know. Bear market rallies are incredibly unpredictable. The only time you have a genuine bear market rally when you have despair. At that point, you can have a rally of anywhere from 3 months to 18 months. And they usually go up 60, 70, 80%. This is just a bear market bounce. It's not a rally.
Okay, so what do you tell Samsung Security clients then? What should they be doing?
There are a couple of things. One of the things they can do is just to buy quality stocks and forget the news flow as much as they possibly can.
But quality stocks also get sold off as well.
They do. But over 5 to 10 year periods, cycles wash out.
Yeah.
Unfortunately, unless you manage your own money, very few people can make that decision. The second decision could be that every time there is despair, you leverage risk. Don't bother about specific stocks. It doesn't really matter that much. All you're doing, you're buying risk. So in the case of China, our market, it's essentially real estate, banking, and commodities. Every time we have run up, you basically de-risk. In other words, you go back to Tsingtao Brewing, you go back to China Telecom, you go back to China Mobile. That could be one of the strategies you could pursue. Right now, we are at a point that I think you should be de-risking rather than increasing risk.
Okay, so get back into the safety plays,
That's
play
right.
defensive.
That's
But
right.
that seems like an overcrowded market, though. Everyone's talking about the same strategy. I guess we'll have to bring you back if we see this vote not working out in Italy, and we are
Absolutely.
in the depths of despair. Victor, good to see you, I guess, after this such a disappointing and I have to say depressing conversation. But we'll see you next time.
Okay.
Thank you for that. Victor Shvets of
Okay.
Samsung Securities.